Imagine a world where accessing and using US dollars is as easy as sending a text message, regardless of where you live or what restrictions your government imposes. That's the promise of stablecoins, and their growing popularity is shaking up the world of finance, potentially impacting everything from US monetary policy to the global economy. I appreciate the opportunity to delve into this important topic today. While some have dismissed stablecoins as just another crypto fad, they've rapidly evolved into a significant part of the financial ecosystem. Initially conceived as a tool for cryptocurrency trading, stablecoins have gained traction because they offer users a stable store of value, a convenient payment method, and the ability to move capital across borders with unprecedented speed. Think of them as digital dollars, designed to be less volatile than other cryptocurrencies. The demand for dollars remains incredibly strong worldwide. It's therefore not surprising that a more efficient way to access and utilize dollars has become increasingly appealing. The recent passage of the Genius Act, Guiding and Establishing National Innovation for U.S. Stablecoins Act, marks a pivotal moment, establishing a clear regulatory framework in the U.S. for stablecoin issuers. This paves the way for them to expand their reach and solidify stablecoins as a core component of the payment system. But here's where it gets controversial. Some argue that overregulation could stifle innovation and push stablecoin activity overseas. Others believe that strong regulation is essential to protect consumers and prevent financial instability. What do you think? Economic research is now playing catch-up. Economists diligently analyze the demand for dollar-denominated assets and consider the potential impacts on monetary policy. The rapid growth of stablecoins is affecting the supply of loanable funds within the U.S. economy. I'm encouraged by the Federal Reserve's increasing recognition of the importance of stablecoins for the payment system. Greater transparency and wider adoption will be essential in helping us fully understand their effect on monetary policy. Stablecoins and the enduring appeal of the dollar. Almost all stablecoins are denominated in US dollars, and their success is inextricably linked to the dollar's continued dominance as the world's reserve currency. In fact, stablecoins are further contributing to the dollar's reach by enabling a growing number of individuals and businesses around the globe to hold assets and conduct transactions in the world's most trusted currency. My core argument is that stablecoins are already driving increased demand for U.S. Treasury bills and other liquid, dollar-denominated assets from purchasers outside the United States, and that this demand will only continue to grow. All other factors being equal, this new demand lowers borrowing costs for the U.S. government. And this is the part most people miss. While this might seem like good news, lower borrowing costs for the government, as a central banker, my primary concern is the potential long-term downward pressure on a critical guideline for monetary policymakers, the neutral rate. The neutral rate, or R*, represents the policy interest rate that neither stimulates nor restricts economic activity when the economy is operating at its full potential, once the temporary effects of economic shocks have subsided. Several important questions arise regarding the impact of stablecoins on U.S. monetary policy. How many assets will stablecoin issuers ultimately manage? Will these funds originate from domestic or foreign sources? And where might substitution pull funds out of the existing banking system? What systemic risks are associated with potential runs on stablecoins? Because monetary policy must be forward-looking, my colleagues and I must proactively explore these topics now. For the rest of my remarks, I'll focus on the potential consequences for monetary policy assuming that stablecoin growth aligns with current industry projections. In short, stablecoins could become a multi-trillion-dollar force that central bankers can no longer ignore. The Genius Act, a step in the right direction. While I generally approach new regulations with a degree of skepticism, I'm very encouraged by the Genius Act. This regulatory framework for stablecoins establishes a level of legitimacy and accountability that is consistent with holding traditional dollar assets. From a monetary policy perspective, the most crucial aspect of the Genius Act is its requirement that US-domiciled issuers maintain reserves backed on a one-to-one basis with safe and liquid US dollar-denominated assets. These reserves can be held in bank deposits, short-term treasuries, overnight repurchase agreements, repos, or reverse repos backed by US Treasuries, or government money market funds. Depending on the source of funds used to invest in stablecoins, this could constitute new loanable funds within the US economy, or affect the overall amount of money available for borrowing and lending. Even stablecoins operating outside the scope of the Genius Act are likely to boost demand for treasuries and other dollar-denominated assets. While these entities have the flexibility to invest reserves in a wider range of assets, they will still likely invest substantially in US dollar securities with minimal credit risk to maintain their perceived stability and reliability. Federal Reserve staff estimates suggest that stablecoin uptake could reach between $1 trillion and $3 trillion by the end of the decade. To put this in perspective, the Fed increased its holdings of US Treasury securities by just over $3 trillion during the latest round of quantitative easing in response to the COVID-19 pandemic. Currently, there are under $7 trillion in Treasury bills outstanding. If these forecasts prove accurate, the magnitude of additional demand stemming from stablecoins will be impossible to disregard. The potential for widespread adoption. The innovation of public blockchains means that stablecoins can trade freely on networks accessible to anyone in the world. This represents a potentially transformative change for consumers and businesses outside the US, particularly in emerging market economies, EMs, or even advanced foreign economies, AFEs, with burdensome restrictions on their payment systems. In many jurisdictions, low-friction payment rails are simply not available. Banking services to convert local currency or assets into dollars may be limited, and basic banking services themselves may be scarce. Billions of people worldwide are subject to capital controls, preventing convertibility and access to dollars. Globally, savers disproportionately favor dollar-denominated assets, and the ubiquity of capital controls is a testament to this preference. For stablecoins to achieve widespread adoption, there must be seamless bridges connecting local fiat currencies to stablecoins. Many potential bridges already exist for traditional dollar transactions. Remittances from immigrants working in the US could be sent as stablecoins. Exporters might receive portions of their payments in stablecoins, perhaps even undeclared if their jurisdiction prohibits stablecoin use. Individuals could trade local currency for cryptocurrency and then use that cryptocurrency to purchase stablecoins. Or they could exchange physical cash, goods, services, or other assets for stablecoins. Stablecoins simply make it easier to navigate these bridges and increase the incentives for doing so, because once stablecoins are circulating within an economy, they can circulate more freely and cheaply behind capital controls than traditional forms of dollar payments. These bridges will not be without friction or limitations. For individuals who desire to use dollars as a store of value or a means of payment, but are currently unable to do so, stablecoins offer an incremental improvement. They won't instantly eliminate all barriers to dollar use, but they will certainly perforate them. Reserve assets and currency provided by the US are global public goods, yet some jurisdictions actively prevent their citizens from accessing them. Stablecoins could provide an easier means for the financially repressed to enjoy these global public goods and circumvent restrictive financial regulations. For individuals and businesses in many nations, particularly those where dollars are used for large purchases such as homes, this also bypasses the challenges of high and unstable inflation or volatile exchange rates. Of course, it's important to acknowledge that stablecoin growth may not reach the levels projected in the forecasts I cited. Limitations on yield and reward arrangements could potentially curb adoption, particularly in open economies. The assumption that the crypto industry will maintain its recent rapid growth is not a given. However, even considering these factors, it seems likely that the use of stablecoins outside the US will continue to grow at a significant rate. One important distinction to consider is that if domestically purchased stablecoins